Your loan officer is tricking you and you don't even realize. Well, actually, let me clarify. Although there's many trustworthy, amazing loan officers in the mortgage space, there's actually, unfortunately, a lot of dishonest loan officers that will try to pull the wool over your eyes. And if they do, and you don't learn all the ways they may do so, it could end up costing you hundreds of thousands of dollars in additional interest and in additional fees. I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner of NAMBY Broker of the Year, top originator across the country via Scotsman Guide, and just a straight-up mortgage MacGyver. All right, so it was a cold Thursday morning in December, and I woke up my kids, got them ready for school, fed them mini pancakes, unfortunately microwaved, I know, dad of the year, and got them all ready, hopped in the car, and we headed to school. So on the way to school, you know, pumping the latest Lady Gaga and all the cool stuff. And what happens? We drop them off, we head back to the car, we look at our phone, and your boy at I am Andrew Russell got a DM. And that person in my DMs answered and replied to one of my stories. That was a shop your rate story on our social medias. And they said, hey, Andrew, me and my husband, we're actually closing in a couple weeks. And I don't know, the interest rate and the cost, it started out one thing, and all of a sudden now we're closing in a couple weeks and the rate is actually a lot higher, and the closing cost, the cash to close for our purchase, is actually a lot higher as well. So I said, OMG, as I normally would. I said, do me a favor, send that loan estimate, that locked document, that locked loan estimate to my team, shoot me an email with the document, let us take a look and review. So it turns out, initially, that loan officer quoted a certain rate and a certain closing cost, but it was a floating rate, which meant it's not locked in. Whatever happened in the market, unfortunately, the client was liable, and the closing costs weren't locked in as well, specifically the origination fees. So, of course, that loan officer waited to the end. The client was closing in a week or two. In this case, it was less than 2 weeks. They locked the rate with the client, but unfortunately, the market got worse, and the interest rate was a lot higher, which meant the payment was a lot higher, and the closing costs were higher, or the origination fees were higher, which meant their cash to close went up. So our team actually took a look, compared it to the current market, and saw they actually locked in at a rate of 7%. With us, the current market on an FHA, it was specifically an FHA loan, was actually 6%. That's a huge difference. And they were charging them 1% in points. So on $1 million loan, 1% is $10,000. So their cash to close went up $10,000. So we were able to eliminate that 1% additional cost because it just wasn't necessary. It just wasn't what the market was at. Didn't require the fee, and lower their rate 1%. So obviously it was a risk. They were, clear to close, closing in a couple weeks, but they were like, you know what, Andrew, I trust in you and your team. You seem to have great reviews, 5 stars. We'll give you guys an opportunity as long as you can deliver an on-time close, which of course we could. So we initiated the application with them. We locked in the rate right then and there at 6% instead of 7%, if you remember, and with no points, no additional costs instead of that $10,000. And we were able to deliver on an on-time close for them within that 2 weeks. And we saved them so much money, both out of pocket and, of course, in interest. All right. I can hear you now saying, hey, Andrew, 2 weeks is not enough time to close. It's such a risk. It's actually not. An appraisal and title are typically portable to whatever lender and loan officer you're working with, and only takes a handful of days to close. The regulations require a minimum of several days to close, but 2 weeks is more than enough time, especially to save money. And I can also hear you saying, hey, Andrew, saving a little bit on rate and a little bit in points is not enough reason for all that time, effort, and energy to switch to a new lender and risk not closing. It's actually not true. In the case of this story of this married couple, that 1% savings in rate was a little over $600 a month less in payment. A month. That's several thousand a year. Call it $7,000 for the year. Times that by 30 years, that's over $200,000 of additional interest that this client would have had to pay if they weren't smart enough to shop their rate towards the end. And of course, that doesn't even take into account the $10,000 of straight up burned money that they were just about to give to that lender that just wasn't necessary. Here are 3 ways loan officers typically try to trick you. Now, the first way it's called a bait and switch, which nobody likes, but unfortunately, it still happens in this environment in mortgage. So let's go over the loan estimate. The loan estimate to me is the most important document that you receive when you apply for a mortgage, and especially when you go to lock an interest rate. So as we go through this document together, it'll show you the bank, Here's your loan estimate, right? The date that it was issued. Now, obviously, back to the future type thing. The interest rate at 3.875. If that was the current rate right now, I wouldn't be on this social media video with you. I'd be retired because I'd be a cajillionaire. But nonetheless, it goes through a lot of different things. It goes through the property address, a sale price, the term. Most mortgages are typically 30-year fixed. Otherwise, it could be a 15, a 20, an adjustable, etc. A purchase, which is the purpose, versus a refinance, a fixed rate. Conventional, FHA, VA, non-QM, all the different mortgage types. Obviously, a loan ID if you have a loan in process with a lender or with a mortgage company. And one of the important things to note, rate lock, no or yes. Now, typically, when you first apply and you first get your loan estimate, that may say no. Now, that just means that the loan is not locked, which then means that you're subject to market. So as you remember in our story, the initial loan estimate they received, it was actually a lot lower than when they locked. And of course, you could always blame the market, right? But it's always important to note, when you get your initial loan estimate, it's not official if it doesn't say yes from a rate lock perspective. So make sure you have that box checked if you feel your interest rate was locked. So as you go through the rest of the loan estimate, here are the loan terms in terms of the loan amount. Can this amount increase after closing? No. Is it negative amortization, which is a loan back during the crash, meaning you paid a small amount per month, but then the loan balance increased? Typically, that'll always say no. The interest rate, can this amount increase, which means it might be an adjustable, right? It's just food for thought. Monthly principal and interest, which is the mortgage. Prepayment penalty, in this case, as an example, this one did have a prepayment penalty, which means if you pay it off before the prepayment penalty ends, in this case, the first 2 years, there's actually a penalty or an additional fee. Always good to know. Sometimes you get a lower rate and a lower payment, but there's a prepayment penalty, which may not be the best thing if you're thinking of selling your house or refinancing. Or a balloon payment, meaning after a certain amount of time, you have to pay the whole principal balance off in full or you're in default. Then it goes through your payments, obviously principal and interest, which is the mortgage, maybe some mortgage insurance. In this case, Michael and Mary, they're putting down about 10%. So in that case, on a conventional mortgage, which it is, there would be monthly PMI. That would be the cost. And then escrow, taxes and insurance. We'll kind of get into that as we go through the rest of the loan estimate. They're going to include in their monthly payment or escrow their taxes and insurance. So they're all in payment. It's $1,050. What I would give for a house for $1,050 a month, that sounds exciting. And then a little bit more of a breakdown as you go down. Now it shows the closing costs, total amount of closing costs, and of course, the cash to close. Now, as it relates to a bait and switch, the bait and switch will have to do with the rate. And as we look into page 2, it'll have to do with the origination fees. Now, as we go through a loan estimate, there are different sections, which we'll talk through. Section A, the origination charges. You see points, which is a fee to get the interest rate. In this case was 3.875, I believe. And then there's other fees you may see on a loan estimate. Now, the good thing about origination is none of this stuff can actually go up. So they typically have to over-disclose to you. But points are market related. So you can go from a loan estimate at initial application showing no points to when you lock in, it could show 2 points, 3 points. And all that means is higher fees to get the loan. We'll talk through that in a little bit. Section B, there's an appraisal. Typically, when you go to buy a property, there's a cost. It can't be higher than that. So that's an overestimate. In this case, $405. And of course, small miscellaneous fees that you may or may not have to pay. Because remember, a loan estimate is simply that. And that's where some of the issues come in. It's just an estimate. Credit report, obviously, they check your credit to ensure that it's of the right credit grade and the right score and all that good stuff. Flood, making sure it's not in a flood zone. Tax monitoring, tax status. Some of these things are small, miscellaneous. You may not even be charged, but it's just an estimate for when you go through the process. You may have to pay it at closing. Now, the section for what you can shop for, a pest inspection fee, a survey, various title insurances, a settlement agent. Obviously, someone's closing the loan, which is typically a notary or potentially even an attorney, depending on the state. That's in Section C. Section E, recording fees, recording the mortgage and the deed, typically with the county. There's fees for that. Depending on the state, transfer tax, which could be mortgage tax, could be mansion tax. It could be transfer tax itself. It gets a little bit confusing. So this is a section that aggregates any type of taxes they may have to pay. In some states, for instance, New York, there could be several that all in amount will be aggregated and put in this row right here, but that's where they place it because not all states have the same fees. Not all states have different types of transfer taxes. Unfortunately, it's not a state-specific document. This is a federal document, so this is how they show it. Prepaids, you have homeowners insurance, you have interim interest, so whatever amount of days are left in the month. You have a dollar amount you pay, in this case, $17 a day in interest. So that equates to an all-in amount for when you close. There would have been, say, 15 days left. You have to pay that amount to close. That's part of the closing costs as well. Initial escrow account. Typically, when you're escrowing for taxes and insurance, you hold a certain amount at closing. So when you start paying per month, when the escrow, when the taxes or insurance comes due, you have enough money in the account to pay it off. So that's a piece of the closing costs. And, of course, owner's title policy. Just a quick and easy explanation of an owner's policy. Imagine you bought yourself a Lamborghini. When you bought a Lamborghini, say you lived in New York and there's a ton of potholes. You get a lot of flat tires and just, it could be very devastating to your car. Would you ever get a Lamborghini and not get car insurance? If you're going to drive it, of course you would get car insurance. Would you ever buy a several $100,000 house and not get insurance for the home, vis-a-vis title insurance? God forbid something happens, there was an issue, the seller didn't really own it. It's the same thing as if you get in a car accident. You always want to get, although it's optional, just like it is for a Lamborghini potentially, you always want to get insurance to make sure you're covered in case something goes wrong. Now, where's the bait and switch happen? So just remember what we said initially. When you get initial application, if the rate lock is clicked off as no, whatever rate they're quoting here is not valid until you lock. So sometimes you can have a loan estimate that has a certain interest rate, and then when you go to lock, that rate would go up. So it's always good to know when you get initial loan estimate, if you think you're locking in, the first piece is it checked off? Yes, you have a locked loan estimate, or if no, whatever they quote you, it doesn't really hold water, because eventually they could always say the market got worse and now your rate is higher. So that's the first way you get tricked, which is purely the interest rate. Now the second way is on the points. Remember, all the other fees in origination, which could be application fee, underwriting fee, processing fee, something called an actual origination fee, points have to do with the rate. So this is where they could say, oh, the market got worse. For this interest rate, this is the cost associated, which is your points. Now, remember the story I told you. Not only did the interest rate in my client's case was 6%, not only did their rate go up to 7% when they went to lock, market-driven allegedly, the points went from the initial loan estimate, which we looked at, had 0, and then the locked one had 1%. That's a section where it can go up as well. So a typical bait and switch, guys, always is the rate and the points. Now, the second way people oftentimes get tricked has to do with the monthly payment. So, say I was a loan officer and this is a non-trustworthy, dishonest, whatever the most appropriate term would be, loan officer. So say I was actually a client working with a loan officer who was actually very dishonest. One of the ways that they could pull the wool over your eyes, which is the second way we're going over, is the payment. So in this case, the payment is $10.50. Now, unfortunately, as we go on page 2, so we see this section here called the property taxes. There is no consequence if a loan officer is being dishonest, unfortunately, and the property taxes they put here to make the payment look artificially lower. Say these property taxes are actually $800 a month. Now that means the payment here is wrong because it's $700 too low. So in this case, the actual payment goes from $1,050 to $1,750 if the taxes are actually higher. If they went from about $100 a month to $800 a month, that's $700 difference. So that's a very typical way that they can give you a sharper loan estimate or a better estimate for your purchase and say, hey, if you work with us, your payment's only $10.50. What's the catch? Nothing. It's just specifically they're playing a little bit of a dishonest game, and they have your property taxes, unfortunately, at too low of amount, knowing later in the process, when they get the title report, it'll just go up. So no matter who you worked with, taxes will always be the same, but the initial application appeared like their payment was a little bit sharper, so you chose them over the competitor. That's typically the second way. Now, the third way, purely a cash to close play. Now, in this instance, it shows between the down payment, which is, as you can see, $18,000. They gave a $10,000 deposit. So there's $8,000 remaining plus the $8,000 in closing costs. So they owe $16,000 to close. Now, what if I told you if the escrow account, it's almost never 2 months. Let's just say it's 6 months. That at closing, they have to pick up 6 months worth of taxes to prepare the escrow account for future payment. And taxes are $800 a month instead of the $100. So as you see here, they were only counting for $200, but the actual truth is $4,800, right? So again, we got that from this estimate had 2 months of taxes, which is almost never, at $100 a month, so that's $200 for the escrow account for taxes, or $800 and 6 months, which is $4,800. So the difference is $4,600 here. So if I was a dishonest loan officer and I sent this loan estimate, it would appear the cash to close at $16,000 was justified. But as it gets trued up, the truth is it should be about $4,600 more in cash to close. Why? Because they weren't being honest with the actual tax amount and the amount being held in escrow. So this is typically the third way that you can have the wool pulled over your eyes. And it's not necessarily a bait and switch. It's not the payment going up or going down or artificially making it appear lower. It's actually your cash to close artificially appearing lower. Like, hey, listen, the deal I'm giving you is so much better than the competitor. Why? Because it's $4,600 out of pocket cheaper, which is not true. No matter who you work with, the escrow will always be the same. So instead of $16,000 to close, it'll turn out to be $20,000 plus, and that may come as a shock downstream. But again, it's a very easy way for a loan officer to pull the wool over your eyes. So how do you ensure you never get tricked? Well, here are 3 quick and easy ways to ensure you never get the wool pulled over your eyes. Number 1, ask for multiple loan estimates from multiple lenders. Now, if you work with a mortgage broker company, they can actually shop your rate around for you, but you definitely have to put your faith in that mortgage broker because they could do the same thing that you've seen here. But make sure you get multiple loan estimates from multiple companies and check their 5-star reviews on Google. Check their reputation online because that plays a huge part if you're getting a valid loan estimate. I mean, listen, previous customers, they'll always be honest typically, right? So check it out on Google. That's advice number 1. Number 2, of course, go over the loan estimate page by page, line by line with your actual loan officer and say, hey, listen, what on this could change? How could it change? Why could it change? Make sure you get an in-depth review of all the items here just so nothing could potentially happen like it did with the client we saved from a rate and cost perspective, how their initial rate went up so much and their closing costs went up over $10,000. Make sure you go over all with the loan officer and you feel comfortable. And of course, third, the most important, as you see here, if you ask for a rate lock, there are documents you get from the lender to prove that it's locked. A text message, a high five, a hug, an email. These do not suffice for rate lock proof. A locked loan estimate with the box checked yes, as we've gone over together, and a written lock confirmation from the lender. If the originator is a broker, the lender's one who's locking it. Make sure you get these documents in writing to cover yourself to ensure that your loan's locked and the rate and or costs cannot go up. So as you can see, guys, we've gone over the most important document in the lending process, the loan estimate. But I can hear you all asking now, hey, Andrew, that's all great, but what is a mortgage? In our next episode, we're going to go over what's an actual mortgage. What does it mean? What are the different types? We'll see you there.